Hey, welcome everyone. I'm Ted Erhart. So my professional focus is retirement planning for individuals over 55, but I also really enjoy talking about investing in economics. And today we're talking about this big trend change that we've seen in the stock market. Much of the excess of the last 24 months has really deflated this year. And with that, we've also seen the humbling of several really high-profile money managers who went from looking like geniuses to fools. And that's really what we're talking about today. I want to point out another classic example of an investment manager or strategy that garnered lots of media attention, pulled investors in, and then, of course, just as people were piling in, things peaked out, and we've seen the same strategy get totally crushed as the trend reversed in the broader marketplace. So that's what we're talking about. Let's get into it. As someone who likes to do a lot of investing personally, I love reading about market history. And one common theme that you'll find if you study market history is during these periods of excess or bubbles, there's usually a handful of people that really embody the broader market sentiment. And this time, one of those people is pictured here, and her name is Cathie Wood. She's a money manager. And she recently rode this market euphoria that really kind of took off at the market bottom early in the pandemic. In March of 2020, stocks went south by about 34%, and then they just took off and essentially doubled roughly 18 months later. But unfortunately for Cathie Wood, she's kind of rode the market back down, going from being famous to probably infamy here, at least in market history, as much of in fact, all of the excess return of her flagship investment strategy was wiped out over the course of just about 12 months. So here's the chart of Cathie Wood's flagship investment strategy, and her approach, if you will, is, at least the story she was telling, is investing in basically cutting-edge technology type businesses that are highly disruptive. And of course, that is the sector, the area of the market where all the excess was over the last couple of years in this pandemic period. What's amazing, if you look back over 5 years, you can see the excess performance generated by her approach, which peaked in early 2021. And, within roughly a year's time, though, all that excess performance is gone. And if we compare that to the broader marketplace, she's now fallen behind. So I wanted to talk about this today, not to pick on Cathie Wood so much, but to make a point about a trap that I see investors fall into over and over again. That being the reliance on past investment returns for making investment decisions about the future. Now, of course, everyone wants to capture better investment returns. I mean, who wouldn't, right? Now, unfortunately, though, for us as humans, our brains are often characterized as pattern recognition machines, which means we're naturally looking to the past to predict the future. And I say unfortunately because in the investment game, that's a very dangerous approach. And the reason is, so often what has been working most recently, the best, tends to be the most overpriced. And we can see that clearly. This is a great example of that. In late 2020, early 2021, the area of the stock market that had just exploded to the upside were all these speculative technology type oriented businesses, and that's where Cathie Wood's fund was focused. And of course, just as she garnered all this attention and so forth, that represented the peak. And sadly for investors who piled in near the top, well, they've lost about 70% of their money. So this is just a classic example of how looking at past returns in the absence of any broader context can be a recipe for total disaster. Now, of course, there's no perfect solution to this problem. One approach would be to just index, be hands-off, let the market sort things out. And that certainly is an effective approach for many, many investors. But if you're like me, you like being in this game, searching for the next great company or the next Warren Buffett, what I've learned is at the end of the day, you have to know what you own. And that means doing your own due diligence, reading the financial reports and the manager commentary. This, of course, isn't going to guarantee success, and reading those reports and so forth isn't going to tell you precisely what to do. But the point is, it's going to give you some basis for making an investment decision and judgment. Because my point is, if all you're doing is looking at the past, imagine it's the end of 2020 and this is what you're looking at, or this entire time frame. If that's all you're looking at to make your decisions about what's going to happen in the future, well, chances are you're going to be setting yourself up for this type of result. So knowing what you own is an absolute essential component of at least putting yourself in a position to make informed and intelligent investment decisions. So look, I just want to say thanks for watching today. Investing definitely isn't easy. Many things are counterintuitive, as we illustrated here, but I hope this brief discussion helps you make some better investment decisions in the future. I hope we'll see you in the next one.